Hey everyone, and welcome back to the Teaching Tax Flow podcast, episode 131 today. We are going to look at a concept referred to as infinite banking and how exactly whole life insurance applies to that. But before we get into it, let's take a brief moment and thank our episode sponsor.
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell him TTF sent you.
Hey everybody, and welcome back to the Teaching Tax Flow podcast. As we always like to say here at the beginning, we have a great topic and a great guest. Of course, this time we actually mean it, like we do all the time, naturally. If we didn't have a great guest or a topic, we'd kick it to the curb. We don't have it. So there you are. There you have it. We give you the best stuff we can come up with. So on this topic today, I know I'm excited about it. I know for a fact that Chris is excited about this one because he was so excited. He actually forgot to invite me to do this recording with this guest earlier today. So here we are. And speaking of that, I like to throw Chris under the bus a little bit, right? As everybody knows here that's been listening to this now on 120 something episodes, I've known this handsome gentleman for 24 years. So of course I like to put it out there publicly that he forgot to do something because that never happens, by the way. So now it's on record. So speaking of that, Chris, I'm glad you're about 1,000 miles away from me because you physically can't punch me in the throat for saying that. But welcome back to your own show, man. How you doing today?
I'm doing amazing. Thanks for letting myself invite myself back. It feels good.
You invited yourself to this recording, but not me. So I see.
I know this is a really rare thing that I forgot to invite you to the recording, but we are both very excited to have an amazing guest. This topic we've been sitting on for honestly a year and a half, trying to find the perfect resource. And luckily, if you're listening to this show, you're lucky, all right? Because the person that's going to talk to us about infinite banking and those concepts today is a nationally recognized speaker. He has, he's either speaking in Costa Rica or on an investor cruise. And luckily for me, when I moved my family from Detroit area to Franklin, Tennessee, I rented a little office out because the kids were so young, and we at the time didn't have a home office. And this gentleman literally had the office right next to me. I owe him countless premium sparkled waters from waddling into his office and stealing. I didn't steal them because I asked if I could have them. But it from someone that was my neighbor, my office neighbor, developed a friendship and actually a client relationship. And Tom and his team have helped my wife and I personally implement infinite banking strategies. This helped us buy our first short-term rental property in Florida. So it's always extra special to me to have someone on here that I've personally worked with. And I'm so excited for Tom to share his knowledge. So Tom Lonnie, thank you so much for joining the Teaching Tax Flow podcast, and welcome.
Thank you so much, Chris. I'm really excited to be here. I love talking about this strategy and how it can help people, because really that's what this is all about, is trying to figure out what is the most effective way to help people get the most out of what they have to work with. So I love the fact that you do these podcasts and get the word out on a bunch of different unique strategies. So thanks for having me, Chris.
My pleasure. And, before we jump into what we're going to call IBC or infinite banking concept, can you give us a little, I love your story. I always feel that, and we talk about this in our practice, and that people don't care how much you know until they know how much you care. And I know your journey to helping people to financial freedom and to implement these infinite banking concepts wasn't your traditional route.
Right.
But it's a route, and I know it comes from passion and comes from experience. So can you tell us a little bit about how you got, what you started doing when you first got into your professional life, and how you found
Yes.
yourself where you're at now?
I totally will, Chris. Thank you. So I started out in a very unique system of really not anything to do with financial products at all. I was a recording engineer in the music industry, and I got a chance to work with just some huge, wonderful artists over that time. People like Bruce Springsteen and REM and the Fabulous Thunderbirds and Aretha Franklin, and the list goes on. I was doing that for 29 years. And during that time, I had a financial advisor come to me and say, "Hey, you really need to get some income protection in case you're ever not able to work," right? And I didn't know, what he was talking about, but this was just a standard disability protection policy. But it had a special provision called an own occupation provision that protected just my hearing. And in the music industry, towards the end of my career, I did lose hearing in one ear and was not able to keep going. So I was like, well, I have this disability policy I bought like 20 years earlier. I'm going to see if it'll work. And lo and behold, it actually paid off and paid me tax-free income. I think it was for 5 years. And it was a very generous amount because I was making a really good income in music. And so I could pretty much do anything new that I wanted to try to do. So I started researching, okay, if I didn't have this particular thing in place, which has nothing, by the way, to do with infinite banking,
Right.
if I didn't have this disability policy in place, I wouldn't be able to do anything right now because I don't have the educational background to do anything but recording engineering. And so I went to school and really tried to learn everything I could about the financial services industry. And I ended up getting, well, right now I have at least 4 financial designations. I just finished my retirement income planning specialist designation. But the the reason I did that, Chris, is because I wanted to help other people not get in the same lurch that I was in. And during that process, I found some unusual strategies that ended up I was really, really attracted to. And one of them was this concept of, rather than saving money in a traditional bank, you're saving money in a life insurance policy. And it absolutely intrigued me. And I was like, okay, I've got to learn more about this. So I ended up going to a conference in Birmingham, Alabama with Nelson Nash and an Austrian economist named Robert Murphy. And it was just so eye-opening, Chris. I can't even tell you, because I'd never heard anything like this. And let me just say, I've been through all the traditional financial planning that is out there, all the classes that you can take in taxes and in insurance and everything, and they don't really touch on this concept. So it's pretty lesser known, I would say, just in the general public, although it's getting more and more popular. But the reality is that back in 2013, which is when I discovered it, nobody had ever heard of it, really. I mean, it was just pretty much a fairly new concept. So I ended up getting what's called an authorized infinite banking practitioner. I went through this whole program, and it was the very first class that they offered to do this. So I've been an authorized infinite banking practitioner literally as long as anybody on planet Earth, since the whole thing started. And I continued on with my education, but I'm telling you, there's nothing that works quite like infinite banking. It is very unique in the financial world, and it has a lot of advantages that most people aren't even aware that exists. So I know you know what it is, but that's kind of how I got into it.
No, absolutely. And there are a lot of tax advantages. We talk about tax agencies are our involuntary business partner, one of the 3 laws of teaching tax flow, and
Yep.
that the power, we do know our country's in debt, and we do, there's a sentiment in the long run that tax rates are going to go up. So to be able to, grow assets in a tax advantaged way, and then have tax, uh, liquidity available, meaning cash available to you in a tax-free way, is very powerful. So, kind of piggybacking on the infinite banking concept, can you give us an idea of what that even is? Because a lot of listeners, let's quite frankly, have thought about term life insurance. Or a lot of them maybe have
Sure.
life insurance with their employer. And what we don't realize is that if your employment terminates for whatever reason, that policy is gone. And this is, and a lot of people think that these concepts are only for people that are older. Now, luckily, I'm gonna share a little secret that Tom, when in working with Tom, um, John's gonna razz me for this, but when we moved to Nashville like 9 years ago, I've always kind of, I'm not in my own life, but I've enjoyed running, and I thought, all right, I'm gonna run the Nashville Half Marathon, and I've done it a few times, but the one time specifically, I was like bound and determined to get my personal best time, and I was able to do that. Still, I'm a turtle compared to most of these runners, but I realized at that time, man, I am like in pretty good shape. And this is, gosh, probably quite a few years ago, but this is a great time for me to reevaluate my entire insurance because I know I'm going to go through a very, I mean, sometimes people say, well, gosh, I don't want to have to get a physical. Let me tell you something. I went through this process. Someone came to my house for 15 minutes, and that was my physical exam. And I got approved as for a very good rate, and that really set my wife and I up, um, for some advantages down the road. So the point is, a lot of people listening, kind of rambled on there, huh? A lot of people listening might be thinking, life insurance, I don't need that. I'm young, I'm healthy. That's when you do really need to consider doing this. So yeah, can you tell me a little bit about what the difference is with specifically infinite banking and what a lot of our mutual clients utilize versus a term life insurance from an employer?
Absolutely. So, well, from an employer, that's actually what would be considered group term coverage. And usually they max that out at about 2 times your income. So, if you're making $100,000 a year, they usually give you like $200,000 a year or so in term coverage from your employer. One of the big disadvantages of that is that it's not portable. There's no portability to it, which means if you leave your work, then you cannot take that term coverage with you, right? It stays with the employer. So it's not that advantageous because the chance of something happening to you while you're working with that specific company is very, very low. So one of the unique things about term insurance is it has a very low cost to it, which is good, and a high coverage amount if you're getting your own personal term insurance. But the negative is the chances of it actually paying off are, well, around 1%, right? There's about a 1% chance that term insurance is actually going to pay off. So in other words, if you were paying $1,000 a year for $3 million of term coverage, and that was for 10 years, the chances of anything happening to you in that 10-year window are extraordinarily small. And then when that 10-year window's up, the price per year jumps astronomically. Like it might jump from $1,000 to $35,000 the next year. And the next year it might jump another 10,000. So it just gets to be insanely expensive and nobody keeps it after that term of years is run up. So I'm not saying there's anything wrong with term insurance. In fact, I have a strategy called the Bulletproof Wealth Strategy, Chris, and I actually utilize a special type of term insurance called convertible term insurance a lot. And what that is, it's term insurance that you lock in your health with, but then you can switch it over to an infinite banking style cash accumulation policy at any time during that specific term of years that you're buying it for. So it locks in your health and gives you the ability to switch to a permanent coverage
Wow,
later.
that's
And it
powerful.
works. So yeah, it works amazingly, amazingly well. And the thing is, term insurance is simply there's no cash that is accumulated in it at all. It's like renting a condo on the beach. At the end of your stay, the condo's somebody else's and you go away, but you had use of that condo while you were there at the beach, which there's nothing wrong with that because you had a good time. Hey, it's a fun beach vacation, but you're not building any wealth doing that,
Hmm.
right? It's just a pure expense. Does
That's
that kind of help?
Yeah, and if you think about it, why do banks allow you to do a 5-year, 7-year arm, right? They're hedging the risk completely. So if you're
Yes.
an arm meaning adjustable rate mortgage. So if you get a mortgage, it's with a 5 or 7 year arm, after that time period, you either have to refinance with the bank or the rate adjusts upwards, most likely. So think about this. When the concept is be your own bank, lock in your health, lock in that now, and then you can convert the term, like I said, to permanent or whole life insurance in the future. So no, that's really neat. So when we talk about infinite banking, it is one of the first steps, obviously, uh, creating having a whole life insurance policy.
So, yeah, and it's not just any whole life insurance policy. So there again, whole life insurance is built on a spectrum from the maximum amount of money you can put in for the least amount of life insurance is designed to accumulate cash, and that's what we do. And then there's whole life insurance where it's the least amount of money you can put in for the most amount of death benefit, and that is just designed for permanent coverage to have a legacy that you're going to leave no matter what. And so infinite banking, it even goes deeper than just whole life insurance. It's about specially designed whole life insurance. And I do 3 primary designs, but I won't get into those right now because I feel like it might be a little beyond the scope for this podcast. But the reality, Chris, is that it works very similar to a home equity line of credit. And I find that most people out there understand the concept of what a home equity line of credit is. So let's just say this. If you had a house that was worth $500,000, but you only owed $200,000 on it, you would have $300,000 of equity. So you could take that equity and tap into it and get a line of credit and borrow against the value of your house. Okay. That's what a home equity line of credit does. And you would be paying the bank interest for the use of their money. And then you would be going out and doing whatever you wanted with that capital. And the deal with infinite banking is it's the same thing, same concept as a home equity line of credit, but you're now building equity inside of a specially designed life insurance policy that you can then collateralize that equity, borrow against it, and then go out and do something with it, like buy a house or fix and flip, or I have all different kinds of people that do this for small businesses or any number of things. But the key to this is that because it's a mutually owned company, you are a part owner and you get dividends every year that causes compounding growth inside of the policy. And you don't get that if you're just borrowing from a home equity line of credit. You don't own that bank that is giving you the home equity line of credit, but you do have a part ownership or mutual ownership in the insurance policy, and that's why you get dividends. So there's a couple of other differences between a home equity line of credit and this kind of cash. It's a cash value line of credit is what it is. And that is that with a home equity line of credit, it does not automatically go up every year. In other words, if you have a $200,000 home equity line of credit, it's not going to change unless you go get another appraisal on your house. You go to the bank and say, may I please have a larger home equity line of credit? They do all these credit checks and financial underwriting on you, and then they decide whether or not you get approved for it. With a life insurance line of credit, every single year it goes up and increases. So you have access to more capital every year. And it works amazingly well because the becoming your own bank part of it is that you don't have to ask permission for that line of credit to go up. You don't have to ask permission for a loan. You just have that as a guaranteed privilege. And the other thing is the rates are a lot more attractive. Like right now, the main company I work with, the rate is 5.3. And it's obviously lower than a traditional home equity line of credit right now by probably 2.5 points. So you got a lower rate because the collateral is more secure.
Yes, it is.
And you have guaranteed growth in the policy. And then if something happens to you, let's just say you had a $2 million life insurance policy and you had an outstanding loan of $200,000, what's going to happen, Chris, is that the death benefit will pay that loan off and your beneficiary would end up with 1.8 million. So that's why this is a great collateral And that's why everybody, in the financial world loves cash value of whole life as collateral because it's incredibly secure. The worst case scenario is that you pass away and then all of a sudden millions of dollars come, into being that weren't there before, and that pays off any outstanding loan. Does that
So a
make
couple of
sense?
things. Yeah, from a tax perspective, I want people to think about that. One, worst case scenario, you pass away, your family ends up with a couple $1 million or more, depending on your
Yep.
situation.
Yep.
Unless it's unless we're talking, unless you have a taxable estate, which is pretty rare, that's all tax-free money, by the way. That's all tax-free.
Yes.
And I want you just, if you're listening, thinking about if we talk about HELOC, right? And the HELOC, but if the mortgage, if the value of your home decreases, your loan to value could decrease. With life insurance, you basically go through underwriting one time. It doesn't
Yeah.
matter what happens to you after that, and they can't come back and say, you know what? No, you're not as healthy as you used to be. You don't make as much money as you used to make, so we're going to decrease your value. So again, kind of that concept. The concept is you're becoming your own bank. And this works really well, for a lot of people, but especially like real estate investors and entrepreneurs. I've been in business 22 and a half years, and every time I go and get a mortgage, I've never really had a problem with it, but there's a lot of anxiety, right? Because there's just, as you know, Tom, there's a lot more red tape we have to go through as
Yes.
entrepreneurs. So you mentioned that. So I want to touch on something that cash accumulates in this life insurance policy, and people are paid dividends. Is it my
Yes.
my understanding that those dividends are tax free while they stay in the policy?
Yeah, the internal buildup or the cash accumulation in the policy is tax advantaged. And the why I say advantaged and not free is because eventually, Chris, in all of these policies, there's going to be a greater amount of capital or cash inside the policy than your basis. And your basis is just how much money you put into it, right? So if you surrendered it and you had $1 million of basis and $2 million of cash value, then there would be a capital gain of $1 million.
Mhm.
But I get around that completely because this also provides a tax-free retirement income stream. And so
Uh-huh.
in retirement, the way it works from a taxation perspective is that life insurance is based on first in, first out taxation. So we can withdraw the basis or the money we put into that in premium dollars out first in retirement. And then
Uh-huh.
once we have no money in it anymore from a basis perspective and it's all capital gains, then we take loans against it for the rest of retirement. And it builds up this enormous loan balance, usually in the millions of dollars. And then rather than paying that loan off, eventually people pass away and the life insurance pays off the loan
Right.
tax free and the balance of the loan goes to the beneficiary. So
Wow.
that's how it's provided a tax-free retirement income and a tax-advantaged accumulation.
And no, that's very important. And let's talk about the loan part for a minute.
Yeah.
Let's assume you've accumulated a cash value and you
Yep.
you take a distribution as a loan. Now that's not a taxable event. You do pay a 5.3% interest, which is less than most mortgage HELOCs and that sort of stuff. But
Yep.
when you pay that loan back, you're paying yourself interest, I believe. Or you're paying the
So
5.3.
so I'll explain this how it works. This is a little bit complicated and one of the things that people get confused about this. So the interest is paid to the insurance company. The insurance company takes that and that is profit to them, and they return their profit back to you in the form of a dividend. So it's not one to one though. It's not I paid $5,000 of interest and now I get a $5,000 dividend. It doesn't work like that. It's I pay $5,000 of interest that goes into the general account. They look at their mortality and expense charges, and then they determine how much dividend they're going to pay, and they return it back to the policyholder. So it's very much you're not paying interest to yourself. Okay, that's one of the things that people get confused about with this. You're paying interest to the insurance company, but you are still getting a dividend even when you have a loan outstanding. And kind of to bring this back to the HELOC analogy, your house if you had a HELOC of $200,000 and a $500,000 house, and you took that $200,000 and went and bought a rental property with it, and then your house went up in value, you're still getting the appreciation on the house, right? And you have the rental property. But with a house, as we saw from 2008 and 9, they can go down in value too, believe it or not, right? Most people now don't think that's possible, but we all know that houses are not guaranteed to go up in value. But with life insurance, like you said, Chris, it is guaranteed to go up in value. It never can go down, which means it's more stable collateral with less risk, and that's why they can charge a lower interest rate. You're never going to get backwards on it.
And what are you finding your clients are utilizing? I mean, you don't have to take the loan, right? You can just let it sit in there and get paid
Yeah.
tax-free dividends, which I know you can't say what the dividend amount is because it fluctuates. I will say mine's, at about 6.5%. I'll speak personally.
Yep.
Um, the money could just sit in there and get a dividend. But for people that take advantage of the loan provision, which is not considered taxable income, what are your clients typically using those proceeds for in general?
That's a great question. So either they used it for okay, I'll just give you a broad category, something they can control. Okay. So I personally don't recommend taking loans from your life insurance policy and, for example, buying stocks that you have no idea if they're going to crash tomorrow or not, right?
Right.
There's too much risk involved in that. But if you have a small business that you have a product you can mark up and you need to buy inventory with it, or I have just a wide variety of things where you are in somewhat control over it, or even if you were going to go buy a rental house where you knew the area and you felt really good about the loan to value and how much you were going to get a good deal for, and you could fix it up and you might be buying a distressed asset. Those things you are in more control over, and that is what most of my clients use their policies for, is just something they have a degree of control over, and it's not wild speculation, and definitely not. It's not a great idea to take loans for depreciating assets. Like, for example, I'm going to take a $40,000 loan. I'm going to take my whole family and extended family to Hawaii for 2 weeks, because at the end of that time, you got nothing. You had the fun, but now you owe the 40,000 back. So Chris, let me touch on this real quick. There's a concept called interest rate arbitrage. And what that means is that you're trying to get in your investment that you take a loan from your policy for a higher return than you're paying in interest. So if you could get a 10.6% return and you were paying the insurance company 5.3%, your actual effective rate of return on that deal is 100%, because you're doing what's called interest rate arbitrage. And I'm not going to go way into the weeds on this, but people generally miss this point, right? This is how banks make money. Banks do not make money by earning 1/4%. Okay, that's what people think. Oh, they're paying me 5% and I'm loaning money at 5.25%. They must be only making 1/4%. No, they're making the spread, because they're not lending out their own money. They're lending out their depositors' money. Okay, banks, in fact, buy a ton of whole life insurance, and they utilize whole life insurance as one of their key assets. It's called BOLI, or bank-owned life insurance. So I teach people about how they can utilize interest rate arbitrage to radically increase their returns. Does that make sense?
Absolutely. And to kind of wrap that up and just say, I'm sure if you're listening to this still, which you should be, and if you're not listening to it, you didn't hear me say that you should be. But you know, when at what point, when are the top 3 or 4 times that someone listening to this should say, was it a good idea to really look at this concept and consider it?
That is an awesome question. So number one, this is something you have to be aware of, is that you have to have a reasonable, you don't have to be in perfect health, Chris, but you have to be in reasonable health for this to make sense, right? You
Mhm.
know, you can't have just had a major health incident like cancer or something like that in the last couple of years. So you were very smart to, while you knew you were in good health, prepping for that marathon, to go ahead and get underwritten. It was great. Right now, we're seeing a lot of clients, because of the new technologies out there, they're able to do electronic underwriting and you don't even have to have a medical exam. And that
Wow.
could go up to $7.5 million of life insurance with no medical exam. In fact, that just happened last week. I had a husband and a wife both get $7.5 million, no medical exam. So it does
Wow.
happen and it's really cool. So you may not even have to have that. So you want to have reasonable health, number one. And number two, you have to be somewhat entrepreneurially minded, meaning like you can do this and just let the money accumulate, the cash accumulate in a policy and never do anything with it. But if you want to maximize this strategy, you really want to have some sort of either small business or entrepreneurial inclination that would allow you to want to leverage it for something that you want to have happen in your life from an investment perspective. Like, I don't use the I word of investment because nothing I do carries a lot of risk with it at all. It's very, 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 very low risk. I think it's even lower risk than putting money in a bank. But when you take a loan, whatever you put that money into is the investment, right? It's
Mhm.
either a small business or real estate or some, one of the things my clients do a lot is they do private lending. So if they can lend their money out, and I've done this in the past too, at 15% return and pay 5.3%, then you're getting almost, 200% rate of return on your money. So it's a very good thing for that. So just to wrap this up, there's three things that this thing accomplishes. It guarantees cash value growth. It serves as collateral for other investments, and it gives you a legacy for your family tax-free. So it accomplishes three things at once, and that's an incredibly powerful use of putting your dollars to work at more than one place at a time.
Absolutely. And so and if someone's has meets those criteria and you're sitting, have money maybe in a bank savings account, money market, earning a very small amount of interest. Also, by the way, that's fully taxable versus,
Yes.
you might as well be tax efficient. So,
Yep.
man, I really appreciate it. And I've learned a lot, even though I've been doing this.
That's
And
great.
Chris, I've
Cool.
been sitting here basically in silence the whole time that Tom, you explained that really, really well. And kind of, how you mentioned the three things. So I kind of think of it, as the trifecta, which
Yes.
is basically I love that term trifecta because it's like three wins right on the scoreboard all in one time. But the way
Ooh.
you describe that, but then also just the process on how it all works, you did a great job explaining that. Because Chris, to your question you had asked, I honestly thought that was the case. Like you're paying yourself interest, but then the more you think about it, you're like, well, how would that even work? Like how does this even exist? Right? You're not adding any fuel to the operational tank, if you will, for somebody to manage this thing because they're not making any money. So
Right.
you did a great job.
Oh,
And yeah,
thank
if
you.
anybody's interested in this, I mean, we make it pretty easy for you. We'll actually drop a link right in the show notes, and you can go directly to the Teaching Tax Flow Hub. So what that is you'll see it when you go on it. It'll have a list of things you may be interested in. Click on them, and we're happy to make introductions for you. So it saves you the trouble of having to trust the Google, as my grandmother would have said. You don't have to go out and search for it. We actually have somebody like Tom. I know you're part of that ecosystem with us there. And yeah, we make it pretty easy. So anybody that's in the audience listening or watching this will again put that link in the show notes to the Teaching Tax Flow Hub and check it out. Let us know what you think and let us know what we can do to help you. And Tom, we'll have to have you back on again here after a while and kind of maybe do a 2.0 a recap or dive a little deeper into some of these concepts as well. Absolutely. And we'll let Chris come back too, I guess. So
Thank you.
well, as I'm coughing over here. It's like my joke. I make myself laugh. But yeah, everybody definitely check out the Teaching Tax Flow Hub, and we'll see everybody back here again on the podcast next week. Different time, roughly, completely different topic. Have a great week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.